Let's get a market perspective going as well. Ambareesh Baliga is joining us in the studio itself. Ambareesh, thanks so much for joining us. Now, we've been talking the figure that actually came at 2.5%. The consensus view is around about 2.4% or so.
Absolutely.
How do you think markets are reacting to this?
No, I think it was already built in to like a very large extent, and we have seen an extremely good market rally in the past couple of weeks. So, unless of course it was a major surprise of 3.5 or something of that sort, I mean, you really couldn't have expected the markets to really shoot up from here based on these figures. So it's more or less in line with what was expected.
Ambareesh, I'm a little confused right now because till about a couple of months back, every time you had a strong print on IIP, the markets would get worried because they think, oh God, no rate cuts.
Right.
Now you're getting a strong print. Is the market supposed to be happy or unhappy? What correlation is working now?
No, in fact, I think the market should be happy. But again, I think the markets will be happy if we see consistency.
True.
I mean, if you have the April numbers better, the May numbers better, possibly that's the time the markets will feel that yes, possibly we are bottomed out. With these numbers, you really can't say that we are bottomed out, because when you talk to people on the street, I mean, you talk to the retailers, you clearly see that there's a slowdown in consumerism. I mean, you look at the vehicle sales, you're seeing a slowdown. So I really don't see any green shoots as of now.
When you talk to Mr. Rathi in the studios again, you get the same feeling that things are not really picking up.
Yeah, but then the markets have moved up because of liquidity. Liquidity is flowing, and because of which it's moved up. You look at the depth in the market, look at participation, which is not there. So because of which you really don't feel that, I mean, you don't really have that good feeling that yes, the markets will continue moving up, should consolidate. I mean, I really don't think so. Because of which I've been saying for the past few days, or I mean, the last 2 to 3 weeks, that at every rise, I think it's an opportunity for you, for you to book out to a certain extent. It's time to stay in cash to a certain extent, because even going ahead, political uncertainty is there. Elections should be sooner than later. Possibly it could be November. I mean, that's the way I see it.
Ambareesh, I want to come to you with the capital goods sector in just a minute, but Mr. Pandey, I spoke to you about this earlier as well. I got your expectations as to what numbers you're working with. CPI. Next week you have those two big numbers, CPI and inflation, both will be released. In your own sense, how do you see, we already have a 25 basis rate cut that's come in, how do you see things panning out from the RBI going from here on the back of all these macro points that we're picking up?
As I said, CPI we are expecting at 9.8, which is still a high number for India. On the other hand, we are expecting some amount of softening bias on the WPI because of the lagged implication of stability of the currency against the fact that the commodity prices were also on the weaker side. So broadly on the WPI, we are expecting about 5.1%, which I know is lower than what the consensus estimate is. But yes, therefore, to a certain extent, the RBI would have incremental room for policy action. But again, as the RBI had been clearly pointed out, that the other macro prints in terms of the fiscal numbers overall, the current account deficit numbers, the saving numbers, all those possibly not be adding up towards providing a significant amount of room for the Reserve Bank of India. So while the Reserve Bank of India would have the responsibility of relatively reducing interest rates, the policy repo rate, to provide that impetus to growth, it would be constrained by the relatively high CAD and the fiscal, which necessarily means that we are building another 50 basis points at the max for the Reserve Bank of India at this point in time for the rest of the financial year, with the next 25 basis points on the 17th of June.
So Ambareesh, with that kind of a background, with the kind of rate cuts that could actually get limited when we talk about the way it could behave over the next couple of months itself, what's the call on the engineering space?
Again, you really don't see the investment cycle really taking off. I mean, again, because the political uncertainties, till the elections are over, you really don't see that investment cycle taking off. And with that background, I really don't see as to how the engineering sector or the capital goods sector can really perform. Because there will be clearly a slowdown in the order flows. And execution, again, we have seen that there has been a slowdown to a certain extent. So, I mean, the way I would see it is, yes, if you're talking of the much longer term, the next 2-3 years, yes, one can be bullish. But do you go out and buy today? I don't think so, because of the slowdown, I think you could get lower levels.
Mr. Rathi, sir, you're a great reader of business sentiment and, of course, how things are really moving out there. I heard a view the other day that don't keep relying endlessly on the India consumption story. It was a bit of a radical view coming from the Indian market, but it really, makes one sit up and take notice, because if the investment cycle is not picking up and therefore jobs and job security and that feeling of prosperity is not all around, are we looking at consumption being under some sort of threat?
It is, but you see, you cannot say India should not look at consumption story. The global markets are not supporting the industry as much. Exports are under a problem. You know the story of trade deficit, you know the story of current account deficit. So it's really the domestic economy which has been driving the growth so far. I tell you, current, IIP numbers, I do not see it either plus or minus. It was something which was everybody expected and predicted, and it's come on the same line. What would continue to worry us is the start of the capex cycle. See, if you don't have the start of today, what is happening? We have a lot of ideal capacity with the industry. Now, cement, for example, I'll take as one sector. We are operating at the lowest capacity utilization, lowest margins, all this. But since not much of the capacities are coming up, you will see the existing capacity being utilized, and you will see the growth numbers coming up. But look ahead, look after 2 years, what happens? No capacity, cement is just an example. In many of the sectors, you don't see capacities coming.
Companies are taking planned shutdowns because inventory is so high.
Inventory is so high, and I don't know whether four-wheeler should be or the car should be taken as an indicator, but two-wheelers certainly are an indicator of how the consumption pattern is going to behave.
Absolutely.
So I think India will have to continue to rely on its domestic growth, because the external sector or the European market are not looking at. US has just started picking up, but it started going great gun. China's start is not that good. So where do you look upon? So you look upon your domestic economy.
No, absolutely. I get that. No, I was speaking more from a market point of view. I mean, this was a market expert commenting about, buying consumption stocks all the time and whether they can sustain their growth. But anyway, so what will change? What will change? Or realistically speaking, is change still 6 months to maybe a year away in terms of picking up investment?
See, these are very difficult calls to take. Every day you see something new happening. Now, Karnataka elections has put in some, positive sentiments. At the same time, the two of the ministers under scandal has put the negative sentiments. Now, you do not know when government will take a call on the election. I'm hoping that there will be no preponement of the election, so you have some kind of stability continuing. Now, the major issue, according to me, which will trigger the growth, is the start of the capex cycle. That changes the sentiments, that increases the consumption in course of time, and it gives a long-term boost to the entire economy. So I think what we have to look at is how to kick-start the capex cycle. Now, there are certain things positive which has happened, not that everything is negative. I think India's growth story still is intact. Fundamentals haven't undergone a major change. I think Cabinet Committee on Investment has taken some steps which are worth noting down. They have started doing some of the powers, plants which are held up. They are talking of starting the road sector by giving the clearance on the land acquisition or right of use or whatever you call it. So there are positives from Cabinet Committee on Investment. But can they speed it up? And can they expedite the growth? The second thing you need is capital. We cannot undermine the importance of capital. It takes care of two problems at the same time. One is your deficit comes down, and secondly, when the capital is available, the cost of capital will come down, and when industry sees security on the front of capital availability, they will take more steps to execute the project. Today you see a lot of uncertainties that look what way the rates are going to behave. If I tie up the rate today, and rates fall down, I am at a loss. If you don't tie up the funds and restart the project, you run a major risk. So I think the major issue today will be how to start the capex cycle, and not from short term, medium term, but also from the long term point of view.
That's a valid point that we've been discussing here as far as how rate cuts and how capex can actually how they tune together. But the other angle which one needs to consider is the liquidity front as well. So come in on that as to how you're looking at liquidity in the banking system, because that also to a certain extent is an important factor.
We've been doing some sort of initial calculations on liquidity month on month for the year ahead. it doesn't look too comfortable open market operations by the Reserve Bank of India. So we would expect that the Reserve Bank of India would have to be much more active in the market in this year, so far as liquidity and addressing the challenges of liquidity are concerned. So for the moment, we are building in about a 50 to 75 basis of a CRR cut, plus a 14,000 to 15,000, 1,40,000 to 1,50,000 crores of open market operations for liquidity to remain stable at around the 80,000 to 1 lakh crore negative on the left. So I think, given the fact that we are not really expecting the adequate space to be created on the balance of payment side, and given the fact that we are not really assuming the Reserve Bank of India to be that much active on the FX side to buy dollars, we would continue to expect a continuous struggle in terms of the structural liquidity constraints.
Indranil, quickly on the macros, this current account deficit number, because it's the biggest buzzword, whether it's corporate offices, whether it's broking dealer rooms, or whether it's currency desks, I think. What estimates are you going with right now? Can we expect a benign number in the months to come?
Benign, I'm not sure. Relatively better, yes. Relatively better compared to FY14, because oil prices appear to be on the lower side and maybe sticking at around the current levels. I'm not really expecting oil prices to crack very significantly. Gold prices have come down, but the only concern with gold that I have is, irrespective of the consignment, capping of the consignment from the banking sector, what is the type of implication that it might have on the gold imports at the lower price points, assuming that the currency remains more or less stable at this point in time. So my belief is that yes, we are better off from a 4.1% current account GDP gap to a relatively better 3.4 to 3.5% on that number. But as RBI rightly always points out, that anything above 2.5% is not a very sustainable zone, and which necessarily means that the reliance on the external capital flows have to be that much on the higher side. Currently the feeling is that the FDI space is relatively better, with inflows likely to be coming into the HUL, the Bharti deal. But overall, I think we would continue to remain stressed in terms of the overall risk atmosphere globally, which will keep the picture hazy and uncertain for some time to come.
Ambareesh, in terms of sectoral allocation, looking at these kind of numbers, or in on a broader sense, what's the strategy in terms of sectors right now? How are you? Which would be the focus areas from a near-term point of view?
I think one needs to again start looking at the defensive space, because after the sort of run-up which we have seen, I think the safer bets would be pharma, FMCG to a certain extent, and then I would surely have some smaller allocations clearly for my earlier favorites, capital goods, infra, because that's where I see growth possibly in the, after the next 12 to 15 months.
That's exactly what I was coming
post elections,
to. Ambareesh has been a real big fan of the India investment story for many years, but even there you're saying only a minor allocation right now. You don't see any green shoots, as you said.
Nothing immediately.
Okay.
But then we should remember that in the longer term, politics do not really matter too much. It matters in the shorter term. So you could actually see them moving up possibly post-elections, but till then I really don't see too much of a upward movement.
Mr. Rathi sir, finally, if you were to put out, let's say, a wish list for the government and for the Reserve Bank, what would be the 2 or 3 pointers be on that list?
I think my list would have been very long.
Very long.
But since you see, on the Reserve Bank front, I think there is a need to strike a balance between fear of inflation, the cost of capital, and the growth. I'm not an economist. I can't give you so many macro, principles and policies, but very simply, if you sacrifice growth, you are buying inflation in the long run. Unless your supply side taken care of, how can you, control the inflation? So I think a balance need to be striken. I heard so many views. People say 50 basis point cut during this financial year plus cut in the CRR. I think that is a reasonable target. But that is not what I get sense from what Reserve Bank speaks. It's a sense from which what we are predicting. So that is as far as the RBI goes. Now, as far as the government goes, I think the first thing is improve the sentiments. Sentiments has a lot to do with investment cycle kicking off. That's one. Secondly, kick-start the projects. You can't have major projects installed and then private sector coming in and start making investment. Third is do something on risk aversion. Look at corporate sector. What are we working on? We are risk averse as of today. We would much rather sit on cash than borrow and burden our balance sheet. We have the corporate sector per se has got a strained balance sheet. Now, if you do global comparison, all that, our number may look better, but we work on different numbers. So, if you take, say, 10-year-old number and say that we are operating at 2-to-1 debt equity, that won't hold good today. Thirdly, banking sector also is getting risk averse, and perhaps rightly so. Their recoveries, every day you come up with the one, that recovery process has slowed down. Now, that again can improve once you have the improvement in the corporate sector, because once the corporate started making profit, perhaps banking sector will get less risk averse. But as of today, you have to handle that problem of risk aversion. I think when it comes to policy front, a lot of policies on the table. I don't think we need more announcement. I think what we need is a immediate execution, speedy execution, which sends a message that look, government means business. If they announce a policy, it will be implemented immediately and in the form and manner in which it is announced.
All right, work up some appetite for risk, get things going on ground and execute. I guess that's the takeaway from this panel. Gentlemen, thanks so much for joining in, Mr. Rathi, Ambareesh and Indranil. Thanks for being with us.
Market just higher by nearly 5 odd points. It's given off most of those gains that we'd actually seen there. You can see that dip coming in. It's actually slipped into negative also at just a couple of seconds back or so is what we saw. But still at 6054 is what we're seeing as far as the index goes. All right, let's take a quick break right now. But when we come back, we put the spotlight on a bunch of other news flow as well as some earnings that are expected today. Coming up in just a couple of minutes. Stay tuned.